Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley.
And I'm Aron Becker, head of European credit strategy.
And today on the program, we're continuing a series of conversations covering the outlook for credit around the world. Morgan Stanley has recently updated its forecast for the next 12 months. And here, we're going to bring you the latest views on what matters for European credit. It's Thursday, June 12th at 2 p.m. in London. So, Aron, it's great to have this conversation with you. Today, we're going to be talking about the European credit outlook. We talked with our colleague Vishwas in the other week about the U.S. credit outlook. But let's really dive into Europe and how that looks from the perspective of a credit investor. And maybe the place to start is, from your perspective, how do you see the economic backdrop in Europe, and what do you think that means for credit?
Right. So on the European side, our growth expectations remain somewhat more challenging. Our economists are expecting growth after a fairly strong start to slow down in the back half of this year. The German fiscal package that was announced earlier this year will take time to lift growth further out in 2026. So in the near term, we see a softening backdrop for the domestic economy. But I think what's important to emphasize here is that U.S. growth, as Vishwas and you have talked about last time around, is also set to decelerate on our economists' forecasts more meaningfully, and that matters for Europe. Two reasons why I think the U.S. growth outlook matters for European credit. One, nearly a quarter of European companies' revenues are generated in the U.S., and two, U.S. companies themselves have been very actively tapping the European corporate bond markets. And in fact, if you look at the outstanding notional of bonds in the Euro benchmarks, the largest country by far is U.S. issuers. And so I do think that we need to think about the outlook on the macro side more in a global perspective when we think about the outlook for European credit. And if we look at history, what we can deduct from the simple correlation between growth and credit spreads is current credit valuations imply growth would be around 3%. And that's a stark contrast to our economist forecast, where both Europe and U.S. is decelerating to below 1% over the next 12 months.
But Aron, you talked about the slow growth here in Europe. You talked about a slower growth picture in the U.S. You talked about, pretty extensive exposure of European companies into the U.S. story, all of which sound like pretty challenging things. And yet, if one looks at your forecasts for credit spreads, we think they remain relatively tight, especially in investment grade. So how does one square that? What's driving what might look like kind of a more optimistic forecast picture despite those macro challenges?
Right. That's a very important question. I think that it's not all about the growth. And there are a number of factors that I think can alleviate the pressures from the macro side. The first is that, unlike in the US, in Europe, we are expecting inflation to decelerate more meaningfully over the coming year. And we do think that the ECB and the Bank of England will continue to ease policy. That's good for the economy and the eventual rebound. And we also think that it's good for demand for credit products. For yield buyers, where the cash alternative is getting less and less compelling, I think they will see yields on corporate credit much more attractive. And I do think that credit yields right now in Europe are actually quite attractive.
So, Aron, another question I had is, if you think about some of those dynamics, the fact that interest rates are above where they've been over the last 10 years, you think about a growth environment in Europe, which is, it's not a recession, but growth is kind of 1% or a little bit below. I mean, in some ways, this is very similar to the dynamic we had last year. So what do you think is similar, and what do you think is different in terms of how investors should think about, say, the next 12 months versus where we've been?
Right. So what's really similar is, for example, the yield. Like I just mentioned, I think the yield is attractive. That hasn't really changed over the past 12 months. If you just think about credit as a carry product, you're still getting around between 3.5% on an IG corporate bond today. What's really different is that over the same period, the ECB has already lowered front-end rates by 200 basis points. And at the same time, if you think about the fiscal developments in Germany or broader rates dynamics, we've seen a sharp steepening of yield curves, and curves are actually at the steepest levels in 2 years now. And what this leaves us with is not only high carry from the yield on corporate bonds, But also investors are now rolling down on a much steeper curve if they buy bonds today, especially further out the curve. So by our estimate, if you aggregate the two figures in terms of your expected total return, credit offers actually total returns much higher than over the past 12 months and closer to where we were in the LDI crisis in 2022.
So, Aron, another development I wanted to ask you about is if you look at our forecasts for the year ahead, our global forecasts, one theme is that on the government side, there's projected to be a lot more borrowing. There's more borrowing in Germany, and then there's more borrowing in the U.S., especially under certain versions of the current budget proposals being debated. So, it does seem like you have this contrast between, more borrowing, kind of a worsening fiscal picture in governments, a better fiscal picture among corporates. We talk about the spread. The spread is the difference between that corporate and government borrowing. So I guess looking forward first, do you think European companies are going to be borrowing more money, and certainly kind of more money on a relative incremental basis at these yield levels, which are higher than what they're used to in the past? And, secondly, how do you think about the relative valuation of European credit versus some of the sovereign issuers in Europe, which is often a debate that we'll have with investors?
Big picture, we have seen companies be very active in tapping the corporate bond markets this year. We had a record issuance in May in terms of supply. Now, I would push back on the view that that's negative for investors and expectations for spreads to widen as a result, for a number of reasons. One is a lot of gross issuance tends to be good for investors who want to pick up some new issue premiums, as these new bonds do come a little bit cheap to what's out there in terms of available secondary bonds. And second, it creates a lot of liquidity for investors to actually deploy capital when they do want to enter the bond market to invest. And what we really need to remember here is all this strong issuance activity is coming against very high maturing volumes of bonds. Redemptions this year are rising by close to 20% versus last year. And so even though we are projecting this year to be a record year for gross issuance from investment grade companies, we think net supply will be lower year on year as a result of those elevated maturities. So overall, I think that's going to be a fairly positive technical backdrop. And as you alluded to it, that's a stark contrast to what the sovereign market is facing at the moment.
So on that net basis, on the amount that they're issuing relative to what they're paying back, that actually is probably looking lower than last year on your numbers.
Exactly.
And finally, Aron, so we've talked a bit about the market dynamics. We've talked about the economic backdrop. We've talked about the issuance backdrop. Where does this leave your thoughts for investors? What do you think looks kind of most attractive for those who are looking at the European credit space?
Opportunities are abound, but I think you need to be quite selective of where to actually increase your risk exposure, in my view. One part, which we are quite out of consensus on here at Morgan Stanley, is our recommendation in European credit to extend duration further out the curve. This goes back to the point I made earlier that curves are very steep, and a lot of that carry and roll down that I think look particularly attractive, you do need to extend duration for that. But there are a number of reasons why I think that that type of trade can work in this backdrop. For one, like I said, valuations are attractive. Two, I also think that from an issuer perspective, it is expensive to tap very long-dated bonds now because of that yield dynamic, and I don't necessarily see a lot of supply coming through further out the curve. Three, our rates team do expect curves to bull steepen on the rate side, and historically that has tended to favor excess returns further out the curve. And fourth is a word we love to throw around, convexity. Cash prices further out the curve are very low in investment-grade credit. That tends to be actually quite attractive because then even if you get the name wrong, for example, and there are some credit challenges down the line for some of these issuers, your loss given default may be more muted if you entered the bond at a lower cash price.
Aron, thanks for taking the time to talk.
Thanks, Andrew.
And to our listeners, thank you for sharing a few minutes of your day with us. If you enjoy the show, leave us a review wherever you listen to this podcast and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.